Welcome to Phillip Mastermind. I'm Kim. The political landscape has shifted dramatically as Joe Biden's withdrawal has led to a surge in support for Vice President Kamala Harris. A recent poll showed Donald Trump leading Harris only by 1 percentage point. This serves as a reminder that the 3 months remaining until the presidential election is a long time in politics. It's obvious that Trump would have preferred to run against Biden than anyone else, though that certainly does not mean his campaign is a lost cause. Hence, all eyes will be on the Democratic National Convention on August 19, where, similar to the Republican convention 1 month earlier, the Democrats will formally nominate their presidential candidate in Chicago. Separately, key upcoming dates include the second presidential debate on September 10 and Election Day on November 5th. The AI boom drove over 70% of US S&P gains last year. And while it remains a key theme in 2024, the focus is now shifting. Investors are moving away from big tech in anticipation of the Fed rate cut soon, which is benefiting smaller companies, banks, and real estate shares. In fact, according to the data from EPFR Global, $10 billion flowed into small cap funds for the week through July 17, the largest weekly inflow since 2007. Meanwhile, semiconductor stocks have experienced a major sell-off since mid-July, driven by sector rotation, concerns over China's restriction, worries about AI demand coupled with disappointing earnings from Tesla and Alphabet. This has caused the tech-heavy Nasdaq to lose about 7% from its peak, while the S&P 500 has dropped around 3% from its peak. And in contrast, the Russell 2000 saw a gain of about 9 to 10% within the month of July. As other sectors began to show benefits from innovation, policy reforms, and appealing valuations, we see this trend indicating a broadening of equity opportunities for the rest of 2024. Back in China, favorable policy news remains the main positive driver. However, despite the anticipation, China's third plenary meeting has come and gone without delivering the significant measures some had hoped for. But the good news is that the China national team is still supporting the market via purchases of ETFs. And separately, PBOC cuts its 1-year and 5-year loan prime rates by 10 basis points to record lows of 3.35% and 3.85% respectively. We foresee the Chinese government may consider more stimulus measures to counter any signs of slowdown in the domestic economy. And finally, China's consumption, the key growth driver in the post-pandemic period, should recover by 2025 as home prices stabilize and supportive policies take effect, despite weak sales and excess supply delaying the property price recovery. The recent Indian budget appears positive as it emphasized fiscal consolidation and employment, boosting India's long-term growth prospects. The growth of capex is maintained at 17%, and such investment will account for 23% of total government spending and 3.4% of GDP. The projected fiscal deficit for the fiscal year is set at 4.9% of GDP, lower than earlier market expectations of 5.3%. Despite a surprise increase in the capital gain tax to a uniform 12.5% rate across asset classes, it's viewed as manageable and unlikely to significantly dampen domestic investors' interest in Indian equities. Credit rating agencies are expected to respond positively to the 2024 budget. And finally, there's a widespread consensus in Prime Minister Modi's ability to maintain his coalition government for his full term, as opposition parties offer little incentive to smaller parties in current NDA government. Back home, the Johor-Singapore Special Economic Zone Agreement is expected to be signed in September 2024, with investment and tax incentives announced in October 2025 budget. While there has been no official announcement on the proposed Special Economic Zone location, it's expected to include Iskandar Malaysia and Pengerang areas. Property firms stand to gain from the heightened developer activity in the region alongside increasing demand for data centers and green industrial parks. Plantation companies holding significant land holdings in these areas are also poised to benefit from the resulting boost in real estate values. Other than that, we believe Malaysia's outlook is still promising, led by the anticipated Fed's rate cut pivot, stable corporate earnings and economic growth, planned investment inflows, and government reforms. In terms of positioning, we think the upcoming political election in the US will be the key event that may introduce greater policy uncertainties, which could have implications for sector positioning and security selection. Our analysis indicates that the investment case for US remains robust, boosted by the corporate's resilient earnings quality. Additionally, there's potential for mean reversion trade given deeply discounted valuations observed in the Chinese market. India has been one of the best performing markets globally in local currency terms and has kept pace with the US markets in dollar terms in recent decades. This trend is expected to continue, driven by favorable demographics and significant investment in infrastructure. Tech-heavy markets like Taiwan and Korea will also benefit from the ongoing tech recovery. Let's not forget Malaysia, which has been one of the best performing markets year to date. While there are numerous opportunities, investors are also closely monitoring geopolitical developments, including the Hamas-Israel conflict, Iran-Israel tension, and the Russian-Ukraine situation. We are equally attentive to global inflation trends, the US 10-year bond yield, global economic growth forecasts, and global interest rate movements. In summary, we reaffirm our belief that there are still opportunities in the market, and we maintain a discerning approach in choosing high-quality stocks for our portfolio. However, it's crucial to exercise caution and carefully select investment options to ensure best risk-adjusted returns. By taking a vigilant approach, investors can potentially reap the benefits of current market opportunities while minimizing risk. A noteworthy avenue for investors seeking diversification in their portfolio is through Phillip Capital Malaysia. Phillip Capital Malaysia offers multiple private mandate services managed by professional fund managers. By leveraging Phillip Capital Malaysia private mandate services, investors can enhance their resiliency, optimize portfolio performance, and navigate the complexities of the market with confidence. Apart from our unique private managed account services, we also offer unit trust funds and PGWA that could cater to different investors' needs. Thanks to our disciplined management, our managed accounts and unit trust funds have achieved respectable returns year to date as of June 30th, 2024. While the past performance does not guarantee the future performance, we continue to strive hard and seek for alpha ideas, investing in companies with strong fundamentals, sustainable business models, clear earnings visibility, and a high-quality management team. That's all for today. Stay tuned for our next Phillip Mastermind. This update is brought to you by Phillip Capital, your partner in finance.